What's going on, guys? Brian here. Today's Tuesday, June 28th, 2022, and the market is closed. Now, I'm very excited to be covering Tesla in today's video. If you don't know what a butterfly spread is, don't worry about it. I will be talking about the butterfly spread, but that's not necessarily important. You can always go look up another video on YouTube or look it up for yourself exactly what that spread is. But more importantly, it's about the concept behind this video. So this is Tesla on the daily time frame. If you didn't know, Tesla tends to hover around any multiple of 100 or 50. So like the 800 level, the 750 level, the 700, 650, 800 level, and so forth. So what I'm going to do is actually turn on those levels right here and we can see it. So we have it again, 600, 650, 700, and so forth all the way up to 900. I don't need to plot every single level on the chart. Now, most momentum traders or most day traders will have you believe that a stock is, if it's going up, it's always going to go up, or if it's going down, it's always going to go down. But that's just not the way the stock market works, especially for any type of mega cap stock such as Tesla. A mega cap stock is a stock that has a large valuation, so anything in the billions, over 100 billion, and so forth. As we can see right here, this is the 600 level last year, and we can see Tesla spent a decent amount of time around the 600 level. This is the 650 level, and we can just look at the chart and see it spent a lot of time around 650, a lot of time around 700, and these are weeks in which it's spent around these levels. Now, if you know how to capitalize on using spreads, you can actually put yourself in positions where you can take low risk swing trades and actually capitalize on a lot of profits, just creating passive income for yourself. So this right here, we can see again, a few weeks it's spent at 650. Look at how much time it's spent here. So if I were to actually just draw a rectangle around each of these plots right here and take a look at how many times it touches these levels within about a month span, and that's plenty of time to actually make a decent amount of profits from swing trading certain spreads. So as I continue along right here, yes, occasionally there will be a gamma squeeze on Tesla. I actually did a video last year on Tesla at this level right here, because this gamma squeeze, I was part of it, swung a call from here and closed it the next day at this point. But we'll leave the gamma squeezes aside and just focus on what it's doing. More than 70% of the time, it's generally going to be trading in a range, which is just like the S&P 500 or again any mega cap stock. So as we scroll down to right here and we can take a look, let's go to the smaller time frame and actually see this is 650, the same levels from the daily, and we can see it right here. 700 spent decent amount of time at 700, spends multiple touches at the 750 level, and then the same thing right here, multiple touches at the 700 level, and then multiple touches of the 650. Now, why am I also isolating Tesla? It's not the only stock that tends to hover around these major levels. It's just because if we scroll around right here and we take a look at Tesla's options premium, we can see that Tesla is one of the largest stocks on the market that has a lot of premium usually traded. It has a lot of liquidity, a lot of volume, and a lot of open interest. So as we see, if we combine these two numbers right here, this is over $340 million in premium currently for Tesla. If we compare that to the SPY, we combine the put premium and call premium, it's 175 million dollars in premium, and we compare that to the Qs, it's roughly about the same, 150 million or so in the Qs. And then lastly, if we compare it to another mega cap stock like Apple, we can see Apple's not even over 100. If you are curious, let's just take a look at Amazon and compare it to another ticker. We can see right here that's 150 million. So right now, Tesla is one of the largest and most liquid options market that there is in the world. So I love trading options on Tesla, and a lot of options traders like to trade Tesla also. If you know how to sell premium, which is the spread in which we're going to be talking about today, known as the iron butterfly, as well as a long call butterfly and a long put butterfly. We'll be getting to that a little bit later, but don't worry about it if you don't understand that now. Just know that Tesla is a beautiful stock to be selling premium because of how much value you generally get from its options. Now, if we jump to one of my favorite sites to use, it's called Option Strat, and we actually take a look at these saved trades that I was in, and let's pull up these two right here because these are the trades in which we're going to be discussing. This right here is what's referred to as an iron butterfly. So on June 9th, when Tesla opened, it actually hit 750, and I opened this iron butterfly. This right here is showing the P&L currently from since that trade was open. So it's currently up about $300. Whenever you're trading an iron butterfly, you're collecting a credit because you're selling an at the money put and an at the money call, and this is what's referred to as the body of the butterfly, and then you're buying an out the money call and an out the money put, thus reducing your risk. So you don't have an infinite risk. The strikes at the bottom are the ones that are being short, and the ones on the top are the ones being purchased. So by doing this, what we're doing is we're collecting a credit from selling these two strikes right here, and then we're using some of that credit received to buy strikes that are further out that are cheaper than the ones in which we sold. And that's what's is creating this spread and we're collecting, in this case, $4,100 in credit, and it's costing us $887 to open. This is how much your broker is going to require you to have in your account for every one of these that you want to open. Let's just say you wanted to grab a few of them because you have a pretty large account and you can, you know, sustain a $4,000 a $4,500 position size. This is how much credit will be received, and you can see it's the same spread, but you're just getting 5 of them. Now, for educational purposes, whenever I do most of these videos, I always talk about just one at a time because I never know who's watching and I never know what everybody's account size is, and you can always scale up or scale down depending on your risk tolerance. Now, as we look at this right here, we can see this is the position size in which it would be. This is just saying these blue lines right here is what's referred to as the break evens, and all it's saying is at expiration, so at the date of July 1st, at the time in which the spread was open, it had 22 days till expiration because it was open on June 9th. As long as Tesla is within this range, the trade is profitable. If we want to know how much profit would be made, you can just hover the mouse over here and it's just going to show what the P&L would be. However, at expiration is generally what we're not looking for whenever we run these types of spreads. We're generally taking a look at what the profit and loss would be by a certain date. In this case, let's just say we were looking at the expiration of Wednesday. How much would this profit and loss be if Tesla was at 750? In this case, the trade would be up $1,400, and would generally lock that in as that would be over a 25% return on the trade. So as I just scroll this back right here, just wanted to clarify that if you want to learn a little bit more how to read a risk profile, I have a couple videos on the YouTube channel about that. Now that I've basically introduced an iron butterfly, I want to also mention why am I using these strike prices and why am I making the wings this wide? As we mentioned, Tesla likes to hover around these strike prices right here. So the 700, the 750, and the 800, as well as any multiple of 50. That's also coincides with a lot of things if we look a little bit under the radar. So let's jump down to this right here and we can take a look at what's referred to as the gamma exposure for Tesla. It generally has a lot of gamma exposure around these whole numbers. So just taking a look at it from that perspective, if we were to come down right here, this is for the expiration of this Friday, by the way. This is just showing a graph of the gamma exposure. So we can see these spikes are at 750 right here. It's at 680. But however, it's massive gamma exposure at 700. If we move right here, we can see another big gamma spike at 680. If I were to turn off the gamma exposure and we take a look at where's the open interest on calls, we can see that the highest points of open interest would be at the 800 strike and the 750 strike. So if we hover right here, we can see that over 15,000 open interest on the 800 strike. If we were to turn on the open interest for puts, we can also see a spike at 700, a spike at 650, a spike at 600, and so forth. So we're taking a look at the options chain. So it has a lot of gamma exposure, it has a lot of open interest around these levels, so price will naturally hover or gravitates or be pulled towards these types of levels. That type of information is pivotal to know if you're trading something like an iron butterfly because you can use that to your advantage. Now, if you're a little bit curious and you want to know, but still, why are you making the wings 50 points wide? Why not make it 25 points wide, or why not go 75 points wide? That's what just having a little bit more information helps. So what we're looking at right here, some of the candle stats on Tesla. As we can see right here, this is the magic number. So this is a 1 standard deviation move for Tesla, what it's saying on the daily time frame. Tesla generally has about a 27-point move. However, for a swing trader, I'm more interested in what does it do from a weekly standpoint. So what I'm going to do is just convert this to weekly candles, and we can see the 1 standard deviation right now for Tesla for the past 365 days, or the past 52 trading candles, 52 trading weeks. 1 standard deviation is just saying over 65 to 68% of the time, what does it generally do? So around 68 to 70% of the time, what does it generally do? And we can see right here 55 points. If we just round that up, we can say it's about 60 points or so. So using 60 points is a good benchmark. Now we'll be looking at the butterfly again shortly and how to manage the trade. But this right here is showing a 1 standard deviation move to the upside and a 1 standard deviation move to the downside. Tesla is generally going to fall within this range right here. So that also is pivotal information because it means we can use this to structure our trades. If Tesla is currently trading at this price, this is the closing price today, or whatever is the last traded price after hours, and we can see right here it's going to close, if it was to rally, around 753. If we were to come to our spread, we can use that information and try to structure it for our break even to be around that point. Now there's ways in which we can manage this trade if it starts to go pretty far, and that's what we'll jump into in a second. But now as we come back to the chart, let's actually take a look at the trade in which I opened here on the chart. So this again was open on June 9th. So let's put on the levels right here, and this would be the entry. So Tesla hits 750, and I decide to open up what's referred to as the iron butterfly, and I'm using the strike price of 800 and using the strike price of 700, and then 750 is my body, essentially saying it's going to stay within this range within a couple weeks or within 1 week or so, because that's all essentially I'm looking for. Because the way the butterfly works is through the passage of time. I'm essentially trying to capitalize on time decay or theta decay. By shorting this call and this put right here, it means as time passes by, these options are losing a lot of money, and you're trying to capitalize on the depreciation of the extrinsic value. So the extrinsic value is essentially another way of just saying the time value. As time passes by, the at the money options generally have the highest extrinsic value. So I really want Tesla to hover around this place right here. But as you guys can see, the way the trade worked, a couple days later, Tesla sold off significantly past what would have been the 700 strike right here. One would say, oh my gosh, that's terrible. You should probably just close the trade and cut it for a loss, but you can actually manage it. Let's take a look at the P&L, however, before we get into the trade management, and take a look what kind of loss would one suffer from running something like that. So at the entry right here on June 9th, the credit received was $4,113. That coincides with what we're seeing right here, $4,113. That was the credit received. This is a graph showing the closing price for the spread itself. Now, there's a little bit of fluctuations that will occur right here, so we can disregard these. These are usually just some sort of flukes whenever these systems are trying to plot the closing price for spreads. It's a little bit harder for the systems to calculate that, but just know this was the price in which it was open, and we can see a couple days later the low of this spread was actually down about 12%, or down $493. That $493, the reason it's negative 12% is because it's a 12% move from how much credit was received. So if the credit received was $4,113 and then the spread is down $493, that's about a 12% decrease in how much decrease on your P&L, because the spread actually increased in value, and that's something you don't want to do. When you sell an iron butterfly, it's similar to an iron condor. You're essentially looking to buy it back for a cheaper price. So the fact that the price is rising, as we can see, let's just say the spread was going for all the way down here, the spread would be down over $1,000 if the cost of the spread was increasing. So we don't want that. We want the spread to lose in value so we can buy it back for a cheaper price. So hopefully that made a little bit of sense right here. So the maximum pain, $493 if we did nothing. However, let's actually just swipe these right here. However, we can see that there was another entry that took place right here. Once Tesla broke past 700, I did get a little bit nervous. I'm not going to lie, because at this point you start telling yourself, oh my gosh, it's just going to keep selling off. What am I going to do? You can make certain adjustments to these trades. So actually, before it actually broke 700, because my break even on the spread was 708 or 710 or so at the time. So around here, you can actually start making the adjustment to the trade. So I'm just showing on the next day, I made an adjustment to the trade. The adjustment was just opening up another butterfly, so this one right here, and now we can see this is what's referred to as a long put butterfly. It's just another butterfly, but this time it's out the money and it's all on the put side. So if price is going to sell off, you can open up a long put butterfly. If price is increasing, you can open up a long call butterfly. If you want another example, by the way, I've done a couple videos on the channel about this, but this one right here was pretty clean and pretty organized. It was on the Russell 2000, so the rut. I was just showing you guys how I actually structured this same scenario in which I'm explaining to you guys right here. What ends up happening is you end up getting this risk profile that looks like this. Online, it's often referred to as the Batman spread, but it's just showing if your initial butterfly looks something like this and price starts to go too far, you can open up another butterfly, and then it creates this structure right here. So that's what I actually ended up doing, and I opened up from this iron butterfly, I open up this long put butterfly. As we can see right here, the P&L currently right now, as the market has closed, since this spread was open, this spread now is up $768 and this one is up $300. So overall right now, the position is up over $1,000. Now I've already closed the trade. I'm actually in another one because I don't like holding them for the week of expiration. But if we jump back to the chart, let's take a look at the P&L of the adjustments. So this trade being down $400 or $500, we can say, this would be the P&L of the adjustment. So as we can see right here, if this was entered for this, when you're doing a long call, when you're doing a long call butterfly or a long put butterfly, it's going to be a debit trade. So don't want to confuse you guys too much a little bit about that. Again, you'll probably want to look up other videos if you're completely unfamiliar with butterfly spreads, as there's a lot to kind of grasp around. Congratulations if you're watching this video and this is your first time you've been seeing a butterfly spread. But what we have right here is this trade actually cost $8 or $835 to open per lot. And then a couple days later, we can see it was actually going all the way up here for about $13. So this trade was actually up over $400 at one point. At the same time, this trade would have been down the $400 or the $500. So these two are kind of negating each other. And essentially what you're looking at on your P&L, it doesn't look like it's just going straight down. Initially, there'll be a little bit of a drop, but once you add the adjustment, your P&L actually flattens out, and then it actually starts returning back to a baseline of 0. And then eventually, as the passage of time, you'll actually start going into the green. So it's not necessarily a scary thing when you see a drop like this of $400. Now, granted, the trade still had 20 something days till expiration, which is plenty of time for it to come back into your favor. And as we can see right here, a couple weeks later or a week later, the trade was well into the green just a few days later. And even as high of today, the trade was actually up 25% or over $1,000. This is the initial iron fly. As Tesla continued to return to this price, as we can see, this is the price in the chart. We can see it did come down to it sold off a little bit more, it came back up, and then we can see as of yesterday and today it actually was still hovering around 750, as it often does. But what one can do, instead of holding their P&L down so much, you can just make a subtle adjustment like that, and then it makes it easier to hold. What you're actually doing is you're also increasing your probability of success, as well as widening your range for profitability. So this right here is the spread in which I'm currently in. So Tesla at 700, I open up another one. Earnings is coming up, so I won't be able to run this. This will probably be the last week in which I can run a spread like this on Tesla. This is just showing I'm in one iron fly right here. This is the risk profile in which we're talking about. The green line right here is what's referred to as the T+0 line. Sorry about that, T+0 line. And that's the P&L currently, and then the Scion level is the P&L at expiration. So let's just say I was to hold this all the way until expiration, which I will not be doing. The max profit would be around this range right here, so about $3,700, $3,800 or whatever, how much credit was received. If I was to jump forward in time now, let's just say we went to next week, Tuesday right here. So let's just go to the Wednesday. So July 6th, we jump forward in time. You guys can see how this P&L curve starts to poke up. And what we're looking at right here is the P&L of the position. If Tesla was still at 700 next week, Wednesday, this is roughly how much the P&L would be. And let me just reset that for a second. What I have is a couple slices. So this is a 650 slice and this is a 750 slice. These slices are just showing an estimation of what the profit and loss would be. So if Tesla tomorrow, let's just jump forward in time one day. If Tesla was to rally 50 points or 55 points or so tomorrow, this position would be down $152. You guys can see that's actually not terrible. Now, granted, I am in one lot. If you're in two lots, this will be down about $300, but that's still not that painful, considering you can build a business plan around just trading Tesla all year round using butterfly spreads. So if we were to let Tesla hover around 750, and let's just say we jump forward in time again, and let's just go all the way to Friday, you guys can see that the P&L actually becomes less and less in terms of the red. If we jump forward back in time, you see down $150. As we move forward in time, we can see now it's only down $118. Just because of theta, this spread is benefiting from the passage of time. However, if Tesla was to get that high up, I will not just sit there and hope it actually comes back down into the 10. That's when you can make the adjustment in which I was talking about earlier. And this is just one example of an adjustment that can be made by opening up a long call butterfly. You guys see how the T+0 line now becomes a little bit wider. And what we've done is we've reduced the risk of delta. So if I was to turn this off right here, the delta, if Tesla was to come up to 750 by Friday, would be almost -5, which means it's hurting me if Tesla keeps going up. If Tesla was to come back down, that'd be great because the delta would benefit as well as the theta. However, because we can't hope or wish or want something to happen, the market, it can do whatever it wants to do. We don't know. Tesla could continue to rally. It might then hover around 750, but then make another leg up to 800 before it then decides to come back down. So in that case, instead of just sitting around and waiting, we can open up a spread like this, and now you guys can see that even if it rallied to 800 is now within the 10th of this calendar. However, I would need to remain in the trade a little bit longer before the position would start going green if we were talking about 800. But if we keep it to 750, you guys can see that this position would actually be green. So if we jump forward in time now, let's just say we went to the following Friday. This is overall the range we're talking about now is about 670 all the way up to 810, and that's essentially covering a 1 standard deviation move for what Tesla has been doing right now. If we jump back to the weekly time frame, we can see right here that's going to cover, depending on where Tesla closes this week, that would more than cover what it normally does, again, about 65 to 68% of the time. We're now accounting for over a 100-point range, because if this is from 700 and then this is from 800, you see we have a little bit more room to the upside, about plus 10 points on this side. And then down here, we have about negative 30 points here. So we're talking about a 140-point range on Tesla now. And over 70% of the time, it's generally going to stay within that range. And even if it breaks outside of that range, chances are it's going to come back into the range. Now, you need to have some sort of risk management plan. So let's just say you can cut it if you're down $300, or overall if you're down 500. However, everybody's trading style is different, but this is just one plan in which you can have to constantly be swing trading Tesla all year round whenever it's hitting these whole numbers. Of course, avoiding things like earnings or avoiding any type of major increase in implied volatility. So maybe let's just put on the show studies, and then let's zoom out. We can see that the increase in implied volatility is something you'll want to avoid. So going into earnings, you can see implied volatility is increasing here as we have earnings coming up. As I said, I'm only going to run this trade for about one more week here before I close it. But during these consolidation periods here, this is opportunities to make thousands of dollars every month. You can expect to make about $500 a week in rotation if you get really good at it. You'll probably take a loss maybe 1 week out of the month. So if 3 weeks you're pulling in about $500 a week or so, and you're just following the rules of managing it when you need to, only waiting until Tesla's around one of these high conviction strikes here or high inflection points, keeping your trading pretty neat, as well as journaling it and making sure to take the screenshots of when you open it. This video was inspired to actually do because when I first opened the trade, I was mentioning this was on the 21st here. This was actually last week when I opened another one. We don't need to discuss every single one which I've opened, but I was just letting everybody know. I got this question here where he asks, if I may ask, what is the thesis behind the 700 strike for the iron condor, which he meant to say is the iron fly, because an iron butterfly is technically an iron condor, but you're just shorting the same strike. Tesla moves very rapidly. Why would it remain within the profit window within 2 weeks? Thanks. I'm not expecting it to wait to stay within the profit window for 2 weeks, because again, the window was pretty tight last week. Once Tesla hit 700 right here, I essentially opened up the iron fly. Here we are a few days later, it was still hovering around 700, and now a full week later it hit 700 again. So I actually went in and I believe I posted this right here. So yeah, same thing. So this is exactly 1 week later. This is when that trade was open, and here we are a full 7 days later, and Tesla's hovering around 700. Yes, it will go past the range and it will make you a little bit nervous. The max drawdown on this position was about minus $200, and now this position is currently up, I believe, over 700 or so. Let's just come to, yeah, $740 is how much that one is now going for. So as I said, I already opened up a new one. So this is the one in which I opened today. It's currently down about $7. I'm only in one of these because when it comes to Tesla, you don't necessarily need to size up that much, because yes, it is more sensitive to news catalysts that can happen overnight in comparison to something like the SPX. I'm more comfortable running these types of trades on the Russell 2000 and the SPX, but you can trade them on this Tesla as it has a lot of premium and a lot of liquidity in the options chain. So to conclude, if we just look at Tesla's daily chart, let's actually turn off all of the studies again and just take a look at this. If you're ever nervous whenever Tesla's really moving, remember, you zoom out and these moves generally don't mean much. I mean, Tesla going from 750 to 800 is a big deal to a day trader. If you're scalping here, yes, but if you're looking to have a consistent trading plan, you're going to do about 70% win rate or 65 or even 60% win rate, and you're looking to trade 52 weeks throughout the year, if you can get your win rate to be about 30 of those weeks being consistently profitable, having some sort of plan, in addition to what you do with your scalping and your day trading, it actually alleviates a lot of the pressure, because if the market is choppy and it's not going anywhere and you have a few of these trades running, it actually makes it easier to scalp because you're a little bit more patient. And you guys can see right here, this is just, I mean, you can go back to any time frame right here. Last year was a major premium killer for Tesla. They were sucking so much premium out of the 700 and the 600 call and put. Everyone thought it was going to rally, and every time it did rally, it always came back down and reverted to the mean, and where we could possibly enter in something like that again for the next few months. During consolidations like this, the major momentum moves only last about 2 weeks or so, and then it tends to die down and cool off, and even as it's coming back down or going up, it totally pauses for a little bit unless it's doing a gamma squeeze, which it has done, but these are generally because of some sort of major catalyst, or because it was significantly oversold, or it's going into some sort of major monthly OPEX or some sort of quarterly OPEX, and OPEX just means options expiration. So we have monthly options expiration, so generally you might want to stay away from those. So we just had one. We can see the next big monthly OPEX is July 15th, so that's why I'm in this one, but I'll probably be closing this trade out around mid next week or so, or towards the end of next week, but I definitely won't be holding it the week of. Finally, as we look at the P&L, again, you guys can see this trade is currently up $300. This is the original one, and the adjustment, which was open up, is currently up over $750. So you combine those two and it's up over $1,000, just having to wait for the trade to manifest itself for about 2 weeks, and you kind of just keep them in rotation. As I close one, I open up another one, and just let it go to work like clockwork. If you enjoyed this video, make sure to like it. Make sure to leave a comment down below if you have any questions. Links to the quant trading app Discord, which is what I was talking about in this video here, where I got some of this data and some of this information. I am the lead developer at Quant Trading App. It's an easy to use service where you can look up a lot of information and data for some of your favorite stocks out there. The gamma exposure, how much premium is in the options chain, as well as identifying where there's liquidity and things like that. Thanks for watching, guys, and I'll catch you in the next one.